Today on The Bottom Line, the falling dollar, Amazon's price cuts at Whole Foods, and Sri-Kumar on how the Fed is blowing it. Hello everyone, I'm Henry Blodget. Welcome to The Bottom Line. We have another great show this week, but first just want to thank Fidelity Investments for presenting The Bottom Line and NASDAQ for hosting us here in Times Square at the market site. The big news this week in the United States has been the catastrophic impact of Hurricane Harvey on Texas and Louisiana. Obviously, lots of concern about the economy. What does it mean? In general, the economy usually handles these things just fine. Far more impacted are the individuals, millions at this point, who have lost a lot, and many have lost everything. So we're going to worry about something, that's what we'll worry about. Behind the scenes, one of the trends that's been taking place for a long time now is the decline of the dollar. If we go back to April, we heard from our president, President Trump, quote, "I think our dollar is getting too strong, and probably that's my fault because people have confidence in me." So, as usual, became about the president, but in that case, he seemed to be right. The dollar is doing very well. Often that makes it hard to do business around the world because it puts pressure on exports. But since then, we have seen a considerable decline in the dollar to the point where it's now hit earlier this week the lowest level since January of 2015. So lots of folks are now watching that, wondering what the impact will be. Good news is, for exports, that's often good. It makes U.S. goods more competitive around the world, so a lot of the S&P 500 do a lot of business internationally, should help that business. But coming back to President Trump, Pedro da Costa of Business Insider this week talked about why the dollar is so low, and he said there are basically two reasons. One, the U.S. economy is actually relatively sluggish now relative to Europe, so things have reversed over the past year, and people are actually losing confidence in President Trump's ability to deliver on his economic agenda. So that may be reflected in the job as well, in the dollar as well. So going back to the President Trump quote, fortunately it may be that people have less confidence than they did in April in the president, and therefore we're seeing that impact in the dollar. But this is a story that we'll be tracking closely in the next few weeks on The Bottom Line. Another week, another new high for Bitcoin, which soared above $4,500 per coin this week. How high can it go, and what does it mean? Well, just to give you an impression of what's going on here, Bitcoin has doubled in August. Many, many years ago, 5 years ago, I remember having a debate around a dinner table when Bitcoin was 30 as to whether it could ever hit 100. That seemed outlandish at the time. We now know the answer to that. Question is, where can it go from here? Before we talk about that, once again, remind you of our view of Bitcoin in general, which is that this is the perfect asset for a speculative bubble. This is a very interesting new technology. It's a limited supply. It's theoretically worth anything because it has no intrinsic value, and it actually does have some practical use. Bitcoin transactions are increasing pretty much week by week over time, which is good. And so if you're looking at Bitcoin from a fundamental perspective, the unit that you want to track actually is Bitcoin transactions. The more it is used, the more embedded it gets in society. Arguably, the more it is worth. That could support a value. But don't believe anybody that tells you there's some intrinsic value here. There isn't. We've said in the past, Bitcoin can ultimately be worth $1 or $1 million. There's nothing holding it back. And a lot of speculators are looking at it and saying, look, the most I can lose if I bet on Bitcoin is 100%. The most I can make is 100 times my money or more. That sounds like a good trade. And if you are a speculator and you are willing to lose everything, those odds do work. And so they are definitely working out for a lot of people. But where does it go from here? Again, focus on Bitcoin transactions for Bitcoin. Gives you a sense of how it is being adopted into society. But something else to watch as you look at Bitcoin is the rise of other cryptocurrencies. Pretty much every cryptocurrency is now going up again. Ethereum, Bitcoin Cash, which was recently forked off of Bitcoin, suddenly seeing a resurrection in its price. So folks are suddenly going crazy about cryptocurrencies in general. That is often a warning sign. Back in the dot-com bubble, which I was intimately familiar with, we saw a lot of profoundly strong companies like Amazon, Yahoo in those days, AOL. Their stock prices were doing incredibly well, but so were the stock prices of lots of companies that ultimately didn't have very strong fundamentals, and ultimately those companies, the stock prices went to zero. So if you're thinking of speculating on cryptocurrencies, sure, For a short term, you may be all right in any of them, but ultimately, Bitcoin is the brand. So we will keep tracking this as we go forward. One of the things that's supposed to happen when the unemployment rate falls to the level it has now is that wages are supposed to go up because there are fewer workers. Companies have to pay folks more to work there. That is not happening. Why isn't it happening? Sarah Silverstein takes us through the Fidelity Insight of the Week.
To put it way too simply, low unemployment usually leads to wage inflation. Fewer people looking for jobs, jobs are harder to fill, people have to offer more money to hire people. So where's the wage inflation we expect to see? Fidelity tries to answer this question in a recent Viewpoints research note. They point out that the link between unemployment and inflation is weaker than it used to be. If you look at the Phillips curve, where each dot represents the unemployment rate and the inflation rate at a specific period of time, and you can see the more recent green dots are further from the trend line. Some of these changes are permanent, like the increase in globalization and automation, and the shift from manufacturing goods industry jobs to service sector jobs like retail that pay less. Service sector jobs are above their pre-recession high. Goods industry jobs, on the other hand, are still 10% below their peak. And look at how the percentage of all employment has changed from goods jobs to services jobs since 1939. But unemployment is also low because of a low participation in the labor force. But this participation is coming back. Fidelity says that we are now close to full employment, which means wage inflation will come, though the peak for this cycle will be low relative to history. And that's today's Fidelity Insight.
Many on Wall Street and the Federal Reserve think that interest rates need to go up because inflation is heating up and we need to control that. Our guest, Sri-Kumar of Sri-Kumar Global Strategy, disagrees, says, in fact, the Fed is basically diddling around and not doing anything. So first of all, on inflation, you think the Fed is basically wrong that we face an inflation threat?
Henry, I think the Fed is wrong. I don't think the inflation is ever going to pick up any time in the foreseeable future with the kind of policy the Fed has been pursuing. Take a look at the numbers which came out about the second quarter revised GDP. The 3% growth got a lot of attention. What didn't get attention is that the core PCI deflator, which is what the Fed focuses on, was year-on-year basis was 0.9%, which is the lowest it has been since 2010. So inflation is going down, it's not going up. The Federal Reserve is 2% target. Janet Yellen told us in June she thinks it is the cell phone price charges and other one-off events. I just totally disagree. I think the Fed is out to lunch. There is nothing in economic theory, Henry, which suggests that inflation is going to head back to 2%.
So what should the Fed be doing then?
One, you can go back in time. Go by time machine, go 3 years ago, and you should have started increasing interest rates 50, 75 basis points at a time, because this was a quantitative easing and the zero interest rate policy was supposed to be an emergency. And that emergency began in December of 2008. And now, 9 years later, we haven't reversed it. So I think that since you can't go back in a time machine, I would say the right thing to do is to increase it by 75 basis points, even 1%. Markets won't like it. Equity investors definitely will hate it. But you have removed a lot of speculative bubble from the market, and then the fundamentals take over. And that's what you need.
And the Fed seems very reluctant to do anything like that. For years, the Fed's been very focused on equity prices, worried about spooking the market. What do you think the Fed will do, and what will happen to the market?
I think the Fed at some point in time may or may not increase in December, but then that is a one-shot increase, and then wait for several more months before even thinking of increasing rates again. They may again start the paring of the balance sheet October 1st, but initially for the first 2 or 3 months, if you're doing only $10 billion a month of paring, it's not going to have a big impact on the market. So they can do that. It is, once again, I call it Mickey Mouse tightening. It is not anything significant. What is going to happen and what will cause a lot of heartburn at the Fed, Henry, is that I watched the 2 to 10 year the yield spread, And that, when it goes negative, as it did in November of 2006, was an unbelievably accurate predictor of a recession 1 year later, which began in December 2007. Remember, the equity market, the S&P 500, reached new highs through the first half of 2008. And we had Jean-Claude Trichet, who was head of the European Central Bank. I call him the hapless Mr. Trichet, because on July 2nd, 2008, he increased interest rates 2 months before the sky fell, thinking that inflation was the major danger. Now the Fed is in a reverse position. They think Fed inflation somehow will go up. They are making the reverse mistake. It's not going to happen. The bond market is going to tell you that as short-term rates increase, the 2 to 10 spread is going to narrow, and you're going to talk about slowing growth and also in terms of a potential for a recession.
So you are focused on the yield curve. You've mentioned the R word that a lot of people say is not in the future at all. Do you think that we are headed for a recession later this year or early next?
I'm saying that now through the end of 2018, we are looking at slow growth. But I will revise that view if I see the bond market give me a different signal. I've always believed that the bond market is a better leading indicator of a recession. It was in the recession of 2001. We had a recession from March to November. It was a short recession. And the bond market went negative about a year to 15 months prior to the beginning of the recession. In this case, in 2008, 2007, 2008, we have a signal of 1 year. The problem with the stock market is it turns out to be either a coincident indicator or a lagging indicator, so you cannot place as much confidence in equities as you can in the bond market.
Now, Sri, everyone for 10 years has been telling me the Fed has been printing money, we're going to get wild inflation, bonds are going to get demolished as interest rates skyrocket, and you're saying the opposite.
That's an excellent question. And again, in my tweets, in my reports to clients, I've been saying for years inflation will not pick up despite the quantitative easing. And I have said the bond yield will go down rather than go up because of the quantitative easing. There are 2 or 3 reasons for that. First is the Fed policy has impoverished low-income earners and people who depend mostly on the bank interest income to make a living, the retirees, for instance. And either you take greater risk than you're supposed to, given your family and income levels, and go for high yield bonds. You go to buy distress investments because you think you're going to get a good return, in which case you're setting yourself up for a fall. That's one option. The second option is, and this is what I hope most of the people are left with, that income level is sharply reduced because the bank interest payments have been close to zero. And therefore, the consumption level has not picked up. And you see that being reflected overall in the last 8 to 9 years. Despite the new revised second quarter number, I would maintain that the consumption is going to continue to remain very weak. Second, look at the bank lending side of it. To create inflation, the banks ought to be extending credit, and people need to be borrowing more from the banks, and the banks currently are sitting on more than $2 trillion worth of excess reserves. Now, unless this money gets lent, it does not create inflation. So the consumers are scared still after 2008, and the banks are not lending, and the restrictive changes in provisions, Dodd-Frank, for instance, after 2008, have curbed lending. So if the banks are not lending and consumers are not spending, you're not going to have inflation.
So if you are right that we will have slowing economic growth through 2018, maybe an increasing risk of recession, yield curve inversion, or at least flattening, what happens to the stock market?
The stock market continues to be supported so far by, again, growing corporate earnings. They have kept the stock market in very good shape. But when that starts turning around, I think there is going to be a likelihood of a trigger for the stock market to come down. Then global uncertainties could be the other trigger, because if you're looking at the price earnings multiple based on the last 12 months earning, Henry, you're talking about 21 times. By Robert Shiller's measure, it's probably the high 20s, so we don't even have to go there. Even the traditional measure is much higher than you would want it to be. So you don't have much room for error. So when you put it together and you say, where is the stock market headed? Any one of various catalysts could cause the stock market to come down. At the very least, I don't see the stock market as a major area overall, the indexes, for you to get additional returns.
So given where we are in the economy and your outlook for both interest rates and the stock market, what should investors do?
I love high-grade paper. I continue to push US Treasuries, 10-year, 30-year paper. High-grade mortgage-backed securities, again, along the same genre to continue to provide good returns. I'm looking at opportunities in terms of in Germany, on the German Bund, for instance, which is again a risk haven. And then I look at the other end of the asset allocation side, go for distress. There is a lot of distress investments that are available in Europe, and I have been saying that this is going to be a big area for growth. And when I talked about the opportunities in Spain, they have turned out to become extremely attractive in terms of returns for investors. Now, Italy is going to offer similar potential, and so you're going to look at distress. So I am at two ends of the barbell, very conservative and also taking a lot of risk with a small part of the portfolio.
Thank you, Sri. Great to have you.
Great to be here and chatting with you, Henry.
Thank you. Amazon's acquisition of Whole Foods closed this week, and no sooner had it closed that we saw immediate impact in Whole Foods stores. Suddenly the Amazon Echo is on sale at cashiers everywhere, at electronics and Whole Foods. And secondly, big price cuts to select items at Whole Foods, including avocados. So anybody who likes those is very good news. So we immediately saw the Amazon strategy taking place. At the same time, we also saw the stocks of other grocery companies get hit again. They have been hit repeatedly since the Amazon announcement. The concern is that Amazon is now going to gobble up a lot of the profit that is left in the grocery industry. Morgan Stanley's analyst had a very good note on this, saying, look, Whole Foods prices are generally about 5% higher than other grocery companies. Amazon will presumably immediately reinvest a lot of that in lower prices, and 70% of the people who don't shop at Whole Foods who could say that the reason that they don't is because it's expensive. So presumably this will lure in a lot of other folks into Whole Foods and allow Whole Foods to capture share faster than it has on the other side. So Amazon making its impact felt immediately. A lot of Amazon and Whole Foods customers are justifiably very happy about that. The larger point here, though, is that once again, Amazon is illustrating that you don't have to maximize profitability, especially near-term profitability, to have your stock price do well. You look at a long-term chart of Amazon, notoriously, the company for 15 years didn't make any money at all, and yet the stock continued to do very well, had a very nice price. Recently, Amazon has started to make a little bit of money, but it is by no means maximizing profitability. In fact, one of the things that Jeff Bezos said early on was, we are going to continue to strive to lower prices always for customers. We will continue to reinvest all of our margin back into the business to make our prices better. And he's also said, looking at the margins of other companies that are trying to maximize profit, your margin is our opportunity. And ultimately, this is very good for customers, but it is also, importantly, very good for shareholders. You can look at that. And so we would argue again that the obsession with Wall Street on profit maximization actually often forces companies to do things that aren't in their best long-term interest. You look at Amazon and Whole Foods, Amazon not afraid to immediately erase or at least lower Whole Foods profit. Stock price went up on that, so investors are on board with it. So you can actually not maximize profit in the near term and ultimately have great stock performance as well. That's all for this week. Thank you very much for joining us. Again, I'm Henry Blodget. This is The Bottom Line. Big thank you to Fidelity Investments for presenting the show, and thank you to NASDAQ for hosting us here in Times Square. We'll see you next week.